let's loop back to something that we started touching on earlier, and that is the fact that principal payments are profits, not cost of debt. A lot of people say, "Oh, but my mortgage repayments are so high. I'm paying principal and interest, and then it's costing me so much." It's actually the interest component is the cost of debt.
Yep.
The principal component, that's profit, right? Because that is equity that you are putting back into the asset, right? That is cash flow that you are sacrificing in order to put money onto the balance sheet. Simple as that. So that is your owned equity. So what you're essentially saying, if you had, let me use the example of the $500,000 property yielding at 6.2% again. Let's assume an interest rate of 3% just to have a baseline. If it was interest only and we were not paying any principal down in year one, based on some preordained property management rates and insurance and all of this kind of stuff, the net cash flow would be $11,300 thereabouts, right? Mm-hmm. Now, if we decided to pay principal as well, the net cash would be about $3,000. So let's just say $11,000 minus $3,000, right? That's $8,000 of cash that we've decided to put back into the asset. So that's pure profit. There's no other way to view that. And so a lot of people get caught up in the cost of debt and they think, oh, it's costing me all this money to pay down these assets, when in actuality, what you're doing is you're banking profits and you're just putting those profits aside in the asset. I think that's a real headbender for people to get their head around, because if you really think about it, the interest component on your investment is the tax deductible component, because that's an operating cost of your real estate business. And the principal payment is just pure profit. Okay, so then you can choose: do you want your profits to be in free cash flow, or do you want your profits to be on the balance sheet as equity? What do you think about that?
Yeah, it's really cool. It's actually, I was thinking about how funny it is that how frequently we refer to balance sheets and profit and loss statements to try and explain and wrap our heads around these kind of concepts. And we talk about it quite a lot between us. But for all the accountants in the room, you can picture like a balance sheet. There's like assets minus liabilities. Assets equals liabilities plus equity. So your liability would be your loan, so your debt that you have with the bank, so that when you're paying down the principal, you're basically reducing that loan, which means that your equity, your owner's equity portion, is increasing. So that's kind of what you mean when you say paying down the principal is actually just profits, because it's your equity that's increasing.
Totally. And if we think about this from a business perspective as well, which is what we should of course be doing, because we are, we're serious property investors and real estate investing is a business enterprise. Yep. If we think about it like that, so there's different ways to run a business too. So you can have high growth, high equity businesses. They got very low cash flow. They're typically the ones that you need to go and raise a lot of capital for, right? Mm-hmm. They're typically ones where you need to get outside investment, do capital raises and all of that kind of stuff. And you might have a lot of equity on the balance sheet, but no operating cash flow. So it's this equation that happens in real time. Like you've got different types of businesses will have different financial structures. The key to having a healthy business that can grow effectively without having to seek outside investment and diluting your equity portions, and in other words, a JV is probably another way to think about that in real estate. Hey, I don't have enough cash flow to fund this. I need somebody else to come into the deal as well. Can you give me some capital? That would be a JV, right? So, but in business, we'd call that an equity partner or something to that effect. Mm-hmm. But it's the same kind of thing. So we can then choose, how do we want to operate our real estate business? Are we generating enough equity already? Are we comfortable with the amount of cash flow we have within and outside the asset? Should we have a higher amount of cash flow? Should we keep our profits liquid by having an interest only loan? That's one way to think about it, keeping my profits liquid. Or if you want to reduce the total cost of debt over the macro, are you better off to pay that down? There's all these different ways to think about it. But understanding that principal payments are not the cost of debt, right? That's you banking profits and stockpiling. That's putting money under the mattress is the easiest way to think about it. Now, what happens though, of course, as you reduce your debt, right? So as you bank profits and put them into the asset, you're reducing the amount of borrowed equity, Okay, so you're reducing the amount of debt you have. You obviously decrease the cost of debt because you have less debt to equity.
Yes.
All right. And so what that can do over the macro is increase the cash flow. Okay. So you've got to play short game and long game with this. But if you can understand that the principle is not you, I'm not paying back, I'm not just giving money to the bank. You're actually giving money to yourself, and that's pure profits. And if you were to look at your real estate investment using, generally accepted accounting principles, GAAP, you would see that would ring true for you too. I think the more that we can start to get our heads around these kind of numbers and start to think in these kind of terms, I think we can make more empowered decisions. What do you think?